Welcome to This Explainer, where we're going to solve the ultimate trader's mystery. Have you ever felt like the market moved exactly how you predicted, but your profits just didn't show it? We've all been there, just staring at the screen like it owes us money. Well, today, we're introducing the secret forces that are actually controlling your profits, the option Greeks. We're going to decode exactly what happens behind the scenes of an option premium. So let's dive right into this. Here's our roadmap for today. First, the option premium mystery. Second, delta, the directional pull. Third, theta, the time thief. Fourth, gamma and vega explained. Fifth, putting it all together. And finally, summary and takeaways. Let's jump right in. Section 1, the option premium mystery. If you've ever traded options, you absolutely know that feeling of intense anticipation right at the market open. But sometimes what happens on your screen just doesn't make any sense at all. Imagine this setup. You do your analysis, you buy a cheap, deep out-of-the-money option because, hey, it costs way less upfront, right? And boom, you guess the market direction perfectly. The Nifty jumps 100 points. You eagerly check your screen expecting a massive windfall. But your premium has barely moved. Maybe it went up by a measly 10 or 15 rupees. Why did that happen? You were right? Why didn't you make money? Well, the answer lies in the hidden gears of the market. Those hidden gears are called the Greeks. Now forget all the complicated academic math you might have seen, just think of them as essential sensitivity measures. We already know that things like spot price, time, and implied volatility affect an option's premium. But the Greeks? They tell us exactly how much the premium is going to change when one of those factors shifts. They basically translate abstract market movements into concrete profit and loss numbers for your portfolio. Section 2, the directional pull. Let's introduce the first member of our cast, delta. This is the Greek that directly answers the mystery we literally just talked about. Delta dictates how sensitive your option is to the underlying asset's price movement. Specifically, it tells you exactly how much your premium will change if the underlying spot price moves by just one repeat. For a call option, delta is always a positive number between 0 and 1. For a put option, it's between 0 and -1. So the crucial takeaway here is, if the Nifty rises by 100 points and you hold a call option with a delta of 0.5, your premium doesn't go up by 100 rupees. No way. It goes up by about 50 rupees. That's your 100-point jump multiplied by your 0.5 delta. And this brilliantly illustrates exactly why that deep out-of-the-money option didn't make you any money earlier. Deep out-of-the-money options usually have a delta of just 0.1 or 0.2. They barely move even if the stock price absolutely jumps. In contrast, at-the-money options move at roughly half the speed of the stock with a 0.5 delta. And deep in-the-money options, they have a delta incredibly close to 1, meaning they move almost exactly like the underlying asset itself. So when beginners buy deep OTM options just because they're cheap, they're unknowingly buying options with an incredibly low delta, setting themselves up for nothing but surprise and disappointment. But hey, delta actually has a pretty amazing trick up its sleeve. It doubles as a quick cheat code for probabilities. Roughly speaking, you can read a delta of 0.5 as a 50% probability that your option will expire in the money. A delta of 0.2, that's roughly a 20% chance. It's an approximate but super useful insider tip to quickly gauge your probability of success before you ever even enter a trade. Section 3, theta, the time thief. Now that we understand direction, let's meet our second character. If delta is all about where the market is going, theta is about how long it takes to actually get there. There's a fundamental difference between buying and selling options when it comes to this relentless vampire of time. Theta calculates how much premium is lost each day simply because time passes. For option buyers, theta is always negative. Time is literally your worst enemy. If your theta is -8, you're going to lose 8 rupees on your premium tomorrow, even if the underlying market stays perfectly flat. And it gets worse. This decay accelerates rapidly in the final week before expiry. But for option sellers, theta is a best friend. Because they sold the option, they want its value to drop to 0. As the premium melts away day by day thanks to theta, the seller is just quietly sitting there making a profit. Section 4, gamma and vega explained. All right, let's introduce the final two forces in our equation, starting with gamma, the accelerator. Think of gamma as the speed of your delta. Just like pushing the gas pedal in a car changes your speed, gamma measures how much your delta will change when the underlying spot price moves by 1 rupee. It's literally the delta of delta. And keep this in mind, gamma is at its absolute highest when your option is at the money, especially as you get really close to expiry. So why does this matter so much? Because of massive, explosive jumps. On expiry day, if you're holding an at-the-money option,
The gamma is so incredibly high that your delta could violently shift from point 0.3 to point 0.8 in just a single hour. This means an option that was moving super slowly suddenly starts rocketing in price with even a tiny market movement. It's literally like strapping a rocket engine directly to your premium. This is exactly why expiry day trading is a massive high-risk, high-reward gamble. Gamma just makes the premium incredibly sensitive and volatile right at the finish line. And speaking of volatility, let's look at our final Greek, Vega. Vega measures your option's sensitivity to implied volatility, or IV. It tells you exactly how much your premium is going to change for every 1% shift in IV. Imagine your Vega is 12. If IV goes up by 1%, your premium jumps by 12 rupees, even if the price and time haven't changed at all. But watch out, because Vega is a serious double-edged sword. It's the whole reason for the dreaded IV crush. Right after a big event, like an earnings report or a budget announcement, expectation drops and IV suddenly plummets. When that happens, this crushing collapse in Vega will absolutely destroy your premium, even if the market moved exactly in the direction you originally predicted. Section 5. Putting it all together. So we've got delta pulling direction, theta stealing your time, gamma accelerating the whole process, and Vega reacting to market fear. Here's our setup. Let's watch these forces battle it out over your hard-earned premium. Imagine you hold a call option, currently priced at a premium of 150 rupees. Your delta is 0.5. Your theta is a -6, and your Vega is 10. Now let's say tomorrow, 3 market events happen simultaneously. Step 1, the underlying spot price jumps by 50 points in your favor. Awesome. Step 2, one day naturally passes on the calendar. And step 3, the implied volatility in the market drops by 0.5%. Let's calculate exactly how our Greeks react to this giant tug-of-war.
And this right here brilliantly illustrates the hidden math of your trades. First, the price jumped 50 points. Thanks to your 0.5 delta, you gained 25 rupees. That is a great start. But wait, one full day passed. Your theta of -6 means you just lost 6 rupees to time decay. Finally, the volatility dropped by 0.5%. With a Vega of 10, that 0.5% drop cost you another 5 rupees. So what's your net change? Well, you gained 25 from being dead right about the direction, but you lost 11 to time and dropping volatility. Your final gain is just 14 rupees, making your new premium 164. This is exactly why you can hit the nail on the head about market direction, but still walk away with a fraction of the profit you expected. The Greeks are always working, sometimes for you, but sometimes against you.
Section 6. Summary and takeaways.
Now that we've totally decoded the mystery, how do you use this structured knowledge to actually improve your day-to-day trading? Here are your key takeaways to memorize. The Greeks aren't just some academic theory. They turn abstract market factors into precise, actionable numbers. Remember, high delta options like your in-the-money or at-the-money options react much faster to price movements. Don't fall for the trap of cheap, deep, out-of-the-money options unless you really know what you're doing. Always remember theta is stealing from buyers every single day, and it accelerates the closer you get to expiry. Gamma is going to spike on expiry day, causing extreme risks and wild price swings. And respect Vega. Always exercise serious caution around major news events to avoid that dreaded IV crush. But you know what the best part is? You literally don't have to calculate any of these manually. Modern broker platforms and apps like Decoding or Sensible display these Greeks live. It is absolutely crucial to make checking them a habit before you place a trade. Which brings us to our final question for you to ponder today. Knowing what you know now about delta, the ticking time bomb of theta, the explosive speed of gamma, and the crushing weight of Vega, are you really still willing to trade blind on expiry day without checking your Greeks? Don't let the market steal your hard-earned profits just because you didn't check the underlying math. Take this knowledge, apply it to your very next trade, and take back control. Thanks for joining this explainer, and we'll see you next time.